In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analyst's predictions are, create a valuation, and review then rate the company. Today we are going to look at PayPal, ticker PYPL. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics achieve or exceed a specific target. Companies can earn 1 point for fully meeting the target or 0.5 points for coming within 2% below the target. The first pillar is earnings per share growth. This is where we take the net income and divide it by the shares outstanding. For PayPal, earnings per share growth over the past 12 months is 4%, which is below the 10% target, scoring 0 points. Next, let's look at free cash flow growth, which measures the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health and prefers companies that can generate substantial free cash flow. PayPal's free cash flow growth is 69%, far exceeding the 10% target, scoring 1 point. Next, we come to revenue growth, which tells us how good the company is at generating income before deducting expenses. PayPal's revenue growth is 14%, exceeding the 10% target, scoring 1 point. Now let's turn to book value growth, calculated by subtracting total liabilities from total assets to indicate equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. PayPal's book value growth is 3%, below the 10% target, scoring 0 points. We then assess the management of the business by looking at return on invested capital and return on equity. These measures allow us to evaluate a company's efficiency at allocating capital. For PayPal, return on invested capital is 13%, and return on equity is 20%, both exceeding the 10% target, scoring 1 point for each. Now we move on to debt. Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow within 3 years. PayPal's debt would take 1.75 years to pay off, which is within the target, scoring 1 point. With the information we have gathered, it tells us that aspects of the key pillars are solid, but let's explore the company further. Now let's look at the remaining key pillars which help define an excellent business. Let's look at the gross margin, which indicates how much money a company retains after incurring the direct costs of producing its goods or services. This is currently at 41%, exceeding the 40% target, scoring 1 point. Next, we come to the operating profit margin, which tells us how much profit a company makes on $1 of sales after production costs but before interest or tax. Peter Lynch prefers companies with strong operating margins when assessing their financial health and competitive advantage. PayPal's operating profit margin is 18%, which 4% above the desired threshold, scoring 1 point. Free cash flow yield provides a more realistic view of a business's financial health. Terry Smith prefers companies with a free cash flow yield of 5% or higher. PayPal's free cash flow yield is 10.00%, exceeding the target, scoring 1 point. Next, we assess the 10-year book value growth as potential shareholders. For PayPal, this is 6%, below the 10% target, scoring 0 points. Lastly, Bill Miller believes earnings growth is the biggest indicator of a company's stock price. PayPal's 5-year net income growth is 20%, exceeding the 10% target, scoring 1 point. In the description, I've included a link to the investors page and the annual report if you want to check it out for yourself. PayPal has demonstrated strong fundamentals in areas like free cash flow, margin strength, and return on capital. However, recent EPS and book value growth have been underwhelming. As of today, the stock is trading at $65.15. Up until the recent market dip, PayPal had been recovering from sideways momentum shown for the last 3 years, as the company refocuses on core operations and profitability. Looking at the overview, we can see the current market cap is approximately $64.45 billion. They are currently generating $31.80 billion in revenue for the trailing 12 months and have 989.24 million shares outstanding, as they have been buying back shares for the last 3 years. At present, their earnings per share tell us that for each share of stock, the company is generating $3.99. Their price-to-earnings ratio is 16.33, which is lower than the S&P 500 average of 26.9. According to Morningstar, PayPal has a narrow economic moat due to its brand strength and network effects in digital payments. The overall consensus among analysts is a buy, with a 12-month price target of approximately $92. Analysts are forecasting an average EPS growth rate of 18% over the next 5 years. Let's calculate a valuation. I will use PayPal's current earnings per share of $3.99. Combining historical growth rates and future analyst predictions, I estimate an earnings per share growth of 11%. Assigning a forward price to earnings ratio of 20, projecting 10 years forward, and applying a desired return rate of 10%, this results in a future stock price of about $227. The current intrinsic value is about $87, with a margin of safety at $65.52. Since the current price of $65.15 matches the margin of safety price, this scores a check. It all depends on your personal view and outlook for the company, as well as the return on the investment you would like to see. When reviewing the key pillars, PayPal scored 9 out of 12, earning a check. Over the last 6 months, the stock has experienced moderate upward momentum as confidence begins to return, scoring a check. Analysts are predicting a growth rate of 18%, scoring a check. The current price matches the margin of safety price, signaling a check. According to Morningstar, PayPal has a narrow economic moat, which scores a check. My final overall rating is 5 out of 5 stars. While the company is on more solid ground than in recent years, there are still areas for improvement that investors should continue to watch closely. Thank you for joining me in today's analysis. Don't forget to like and subscribe for more insights.